Hey traders, welcome back to the channel. It's been a minute since I made a video, but that's just because nothing really exciting has been going on. I'm just doing my trading the same way that I always do and, achieving similar results. So like I've said a million times on this channel, I don't want to keep on making the same video. So that's why I haven't made any videos recently about my, quote unquote normal daily operation, because I essentially do the same thing every single day. And if you've watched any of my other videos on this channel, I think I have nearly 100 other videos at this point uploaded to the channel. Those videos will show you exactly what I do, how I do it, why I do the things that I do. So just go ahead and watch those videos if you want to learn a little bit about my actual day trading strategy. But what we're doing today, it's going to be the start of something brand new that I've decided that I'm going to start doing. And the reason for this is that I really do like making videos. It's fun making videos. It's fun creating content. But like I just said, I don't want to keep on making the same video. So what's the solution to that? To keep on making videos but not repeat myself, doing the same thing all the time? The solution is I decided I'm going to start doing a daily market recap. And after the market closes every single day, I'm just going to take a look at what happened during the course of the day and make a fairly short wrap up of the day's activity. And, give my 2 cents as to what it all means. Kind of tell you what happened during the day and then kind of put it all together when we're done. And I'm going to try and keep it brief, like somewhere between 5 and 10 minutes, but the goal is to be under 5 minutes every day. Just basically do a quick wrap up of, this is what happened today and here's what it means in my opinion. So let's go ahead and do the first one of those right now. So right now it's Tuesday night, December 16th, and we got the jobs data today, and we've been waiting weeks for this jobs data, as you know, because after the government shutdown delayed everything, we didn't have access to the numbers, but the numbers finally dropped this morning, and they're actually telling us a story that the market's not really very happy about. And therefore, the S&P was down for a third straight session today. Unemployment hit a 4-year high, and the Fed's rate cut playbook just got a lot more complicated. So let's break down what happened today, and I'm going to let you know what it means for your trading into the year end and just a few of the things that I'm looking out for as we go forward. So the big picture today is obviously the jobs shocker. This morning we finally got the October and November jobs reports that were delayed by the government shutdown. And here's what matters about that. In November, we added 64,000 jobs, and that's better than the 30,000 expected. So on the surface, that looks okay. But here's the problem. October lost 105,000 jobs. And that's not a revision. That's a massive net loss. So basically, the labor market didn't just slow down in October, it contracted. And the unemployment rate was 4.6%, which is the highest level since September 2021. That's up from 4.2 a year ago. Unemployment hit 8.7%, which is also the highest since 2021. And so, as you can imagine, the market's reaction to this was cautious. So today we opened lower and stayed lower throughout the session. The S&P fell for the third straight day, as I mentioned at the beginning of this segment, and Treasury yields dipped as traders started pricing in that maybe the Fed will need to cut more than they thought they'd have to. But here's what's critical. The data is noisy because the BLS itself warned that the shutdown's effects, quote, might linger for several months. So we're basically trading on incomplete, messy data, and that creates opportunity if you know how to read through the noise. And this opportunity that I'm speaking of can come in the form of extra volatility. You could probably see for yourself on a lot of charts today Lots of volatility, lots of real wild swings up and down. It certainly wasn't a smooth sailing type of day today. But if you're quick, and when I say quick, I mean scalpy, like in and out within minutes, you could have made pretty good money going long or short in either direction today. So, when I say read between the lines or see through the noise, I'm talking about being nimble and staying on your toes and reacting quickly to very big price swings up and down in the market as the day unfolds. So what does this all mean for the Fed? Well, basically last week, the Fed cut rates for the third time in 2025, bringing us down to a 3.5 to 3.75% range. And they signaled that they weren't in a hurry to keep cutting. They wanted to see more data on inflation and jobs before making the next move. Well, now they've got their jobs data and it's weak, but inflation data is coming Thursday with the November CPI report, and that's going to be the other half of the equation. So here's the setup. If the CPI comes in hot on Thursday, that means the Fed's stuck. They've got a weakening labor market, but persistent inflation, and that's the worst combination. They can't cut aggressively without risking inflation re-acceleration, but they also can't hold tight without risking the job market deteriorating even further. The market is currently pricing in only about a 20% chance of a January rate cut. But if Thursday's CPI is soft and these job numbers hold up as genuinely weak, those odds are going to jump fast. And that's your volatility setup right there. And while everyone's been focused on the macro data, the real story is the ongoing sector rotation that's been happening since last week. Tech stocks, especially AI names, are getting crushed. Broadcom fell over 5% today, Oracle down over 2%, Microsoft took losses, and these were the market darlings for months, and now the money is flowing out. And I know this personally because I trade a lot on tech names, I trade a lot on AI names, and I've seen the fact that a lot of these names have been having a bit of a hard time recently. So where are the trades going? They're going into economically sensitive sectors like consumer discretionary, industrials, healthcare, basically anything that benefits if the Fed has to cut rates more aggressively because of a weakening economy. So this is classic late cycle rotation. When the labor market weakens, traders rotate into defensive plays and sectors that outperform when rates are falling. And the fact that the Dow only dropped 0.09% yesterday while the NASDAQ fell 0.59% tells you everything. This is a stock pickers market, not a passive index market. And so now we get to the main question. What do you do with all of this information? How do you trade it? How do you make money on it? Well, there's 3 actionable plays. First, Thursday's CPI report is now your most important data point of the month. So if inflation comes in at 2.5% or lower, expect a massive relief rally in rate-sensitive sectors like utilities, REITs, and dividend stocks. And second, don't chase the AI sell-off. Broadcom, Oracle, and these names got ahead of themselves, but let them try to find support and don't try to catch a falling knife. Wait for technical confirmation, either a higher low or a breakback above key moving averages. Third, watch the Russell 2000 small caps. They hit an all-time high last week but pulled back. If the Fed pivot narrative strengthens, small caps are your highest beta play to interest rate cuts, but they're also most vulnerable if we're heading into a real slowdown, so size appropriately. And for options traders like myself, volatility is starting to pick up. The VIX is around 17. That's elevated but not panicky. And so, as you know, if you've watched this channel at all, I actually like volatility because I like to be scalpy and I like to take advantage of everyone's indecision. And if you know candlestick action, price action, you know how to read the candlesticks, you can jump in and be fast on these moves up or down and make money that way. So that's the way that I like to trade. So the bottom line, today's jobs data showed us a labor market with real cracks forming. October's 105,000 job loss is not something you can ignore, even with November's small bounce. Unemployment at 4-year highs changes the narrative, but we're trading on incomplete data because of the shutdown, and Thursday's CPI will either confirm or contradict the Fed needs to cut more story. The next 48 hours are critical. I have no idea what's going to happen tomorrow, Wednesday, but I definitely expect Thursday to be a wild trading day. So what does this mean? Stay nimble, as I've already said, manage your size. Don't let recency bias cloud your judgment. The market's giving us mixed signals right now because the economy's giving us mixed signals. So trade what you see right in front of your eyes, not what you want to see. The worst thing you could do right now is get an idea in your mind of, oh, I've got an idea this is going to happen, and then trade based on a bias rather than simply looking at the charts and the candlesticks and trading right what you see in front of you. I mean, this is always the right way to trade no matter what, but in times like these right now, meaning, tomorrow and Thursday, it's especially important. So that's it for today. Quick wrap up of the market's action. As always, if you'd like to know how I trade options every single day, go to lonewolftradingclub.com. You can get my courses. I've got 2 courses available on there. One is my basic general trading strategy that I use every day, and the other one is a more specific candlesticks only focused course. I've also written 2 books on Amazon. You can get those on Amazon, obviously. Secrets of the Lone Wolf Trader is the first one, and Lone Wolf Trader Presents Mastering the Mental Game is the other book. And until tomorrow, I hope you have a good trades tomorrow. And I'll be back here with another wrap up tomorrow. Take care, everybody.